India's Budget 2024 has introduced significant changes to the country's financial landscape, particularly in the realm of taxation. One of the most notable changes is the implementation of a new capital gain tax. This move has sparked considerable debate and discussion among investors, economists, and the general public alike. Understanding the implications of this new tax is crucial for anyone with a stake in the Indian economy. This essay aims to provide a clear and concise explanation of India's new capital gain tax. We will delve into the specifics of this new tax regime, as outlined in Budget 2024, and examine its potential impact on investors and taxpayers. Additionally, we will explore the rationale behind the government's decision to introduce this tax and analyze its possible economic ramifications. Before delving into the specifics of India's new tax structure, it's essential to understand the fundamental concept of capital gain tax. In simple terms, capital gain tax is a levy imposed on the profit earned from the sale of a capital asset. A capital asset can be any asset that is expected to appreciate in value over time, such as stocks, real estate, or even a prized painting. When you sell a capital asset for a higher price than you purchased it for, the profit you make is considered a capital gain. Governments impose capital gain taxes on these profits as a way to generate revenue. The rate of capital gain tax can vary depending on several factors, including the type of asset sold, the duration for which the asset was held, and the prevailing tax laws of the country. Budget 2024 has brought about significant changes to India's capital gain tax structure. The new regime introduces a revised tax rate and alters the holding period that determines the tax liability. Under this new system, the capital gain tax rate has been increased, impacting how profits from the sale of capital assets are taxed. Furthermore, the holding period for assets to qualify for long-term capital gain tax benefits has been extended. This means that individuals and corporations need to hold on to their assets for a longer duration to avail themselves of the lower tax rates associated with long-term capital gains. These changes have been met with mixed reactions, with some experts lauding the potential increase in government revenue and others expressing concerns about the impact on investment sentiment. Section 4. Impact on investors and taxpayers. The introduction of the new capital gain tax regime in India has wide-ranging implications for both individual investors and taxpayers. For individual investors, the increased tax rate on capital gains could potentially reduce the net returns on their investments. This is particularly significant for investors who rely on capital gains as a source of income or those who frequently trade in the stock market. On the other hand, the government's rationale for introducing this tax is to create a more equitable tax system and generate revenue for public welfare initiatives. The increased tax revenue collected from capital gains could potentially be used to fund infrastructure projects, social welfare programs, or reduce the fiscal deficit. However, it remains to be seen how effectively the government will utilize this additional revenue stream. Section 5. The rationale behind the tax. The Indian government's decision to introduce a new capital gain tax is multifaceted and rooted in a number of economic and social considerations. One primary motive is to enhance tax revenue collection. Capital gains, particularly from stock market investments, have witnessed substantial growth in recent years, and the government aims to tap into this revenue stream to bolster its coffers. This increased revenue can then be directed toward funding essential public services and development projects. Moreover, the government seeks to foster a more equitable tax structure. The previous capital gain tax regime was often perceived as favoring wealthier individuals and corporations who could exploit loopholes and exemptions. By revising the tax rates and holding periods, the government aims to create a more balanced playing field and ensure that those who benefit most from capital gains contribute their fair share to the national treasury. Section 6. Economic implications and future outlook. The long-term economic implications of India's new capital gain tax are still subject to debate and analysis. Some economists contend that the increased tax rates could potentially dampen investor sentiment, particularly among short-term traders. This could lead to a decrease in trading activity and potentially impact market liquidity. However, others argue that the impact might be minimal, as long-term investors are less likely to be deterred by the tax changes. The effectiveness of the new tax policy will depend on various factors, including the government's ability to implement it efficiently, address any potential loopholes, and utilize the additional revenue effectively. The government's commitment to transparency and clear communication with stakeholders will be crucial in shaping investor confidence and ensuring the long-term success of this new tax regime.